Hey, this is Tom Nash, and let's do an objective, no BS, no hype, no hate, DCF, real cash flow valuation model on Tesla. Intrinsic value without all the nonsense, all the noise. I'm not going to be fanboying over the company. I'm not going to be hating it. You're not going to see crazy $3,000 price targets. You're not going to see something silly like Gordon Johnson says, like $50 a share. No, actual intrinsic value. The value of the cash flows of Tesla over the life cycle of the company, discounted back to today by adjusting it for risk. Let's say that we play a game, and in that game you get a coin, and you can throw this coin in the air, and wherever it lands will determine how much money you get. If it lands on heads, you get $1 million, but if it lands on tails, you get $0. And there's no do-overs. You do it once and that's it. So it's a 50% chance of winning $1 million. I mean, it's a lot of money. But what would you say if I told you that I'm going to give you a choice? And that choice would be to take a certain amount of money not to play the game. Instead of having a 50% chance at $1 million, I'm going to give you a 100% chance at something less. How much money would you take to walk away from this game? Now, most people will say $200,000, $300,000, something in that range, they would walk away from this game. Unless they're super risk hungry, which most of us here are not. So if 300,000 is your amount, your essentially replacement value, then the risk adjustment you're putting on this game is $700,000. That $700 is being adjusted for your risk because it's a lot of risk. It's 50% risk of getting nothing. So the risk adjustment here is 700,000 out of $1 million. That's all it is. That's literally what discounted cash flow valuations are. You tally up all the cash flows of the company, and then you use a risk adjustment mechanic to figure out how much they're worth today when you eliminate all the risk. Simple as that, or rather account for all the risk. So let me pull this up on the screen. I'm going to tell you right away, a lot of people are going to be pissed at me for doing this because it's not going to make anybody specifically happy. The Tesla bulls are going to call it absolute nonsense. They're going to say it's bearish. The Tesla bears are going to call me a Tesla bull, saying it's too bullish. But the idea of a good model, the idea of a good valuation is that we simply do not care. Simple as that. We're going to do something that serves us, which is finding our own intrinsic value. If you want to learn how to do this, join our 4,200 member Patreon community on patreon.com/TomNash. That community, in my opinion, is the best investing community in existence. We have a lot of resources. We have Tesla rooms, Palantir rooms, and it's insanely active Discord, an academy for stock investing. So much going on. I urge you to check it out. And I'm going to talk about the academy towards the end of this video. I don't want to bore you with this. So now I'm going to remove this little thing right here. And let's go back to the data. So for us to perform a DCF on the Tesla, we need to be able to know how to adjust the amount of cash flows we're going to find in a second. What's the risk adjustment here? Well, this is it. It's called the weighted average cost of capital. And this is how you adjust for it. So number one, you essentially have a mixture of debt and equity. And your debt cost and your equity cost are being blended. And then you get something that is representative of your weighted average cost of capital. And we use that as a discount rate for our DCF. So as you can see, Tesla accidentally does not have any debt. So the whole debt side of the WACC calculation doesn't exist. So Tesla's WACC, weighted average cost of capital, will be determined solely by its equity because it doesn't have any debt. And in that case, the calculation becomes very, very simple. All we do is we look at the risk premium, which is 5%, which is S&P 500 expected return this year minus 3.7. So I think it's very fair to say that this year we have a 9% expectation from the stock market, from the S&P 500. So a 5% risk premium is totally okay. So Tesla is operating at 2 beta. A beta is the amount of volatility of a company compared to the index. So 2 beta is not low. Risk-free rate is 3.73%. That's the 10-year treasury. And then the equity cost is a calculation by taking the risk-free rate and adding it up to beta multiplied by the risk premium. And that's how we get 14% right here. So 14% is the discount rate for Tesla. Now, before you celebrate, the higher the percent is, the worse it is for the company. The higher the percent is, the lower the valuation will end up being. So a 14% discount rate is considered very high, very, very conservative, and it will work to the benefit of our model because it's going to make the model better because we're not using something silly like 7 or 8% discount rate. It's actually higher than what it should be. And that's good. So what I've made here, essentially I've made some assumptions. You can go over them later. But as you can see, I'm focusing on Tesla Auto. I'm not talking about the insurance business, the Optimus Prime, the AI business, the robotaxi. None of this is here. So I'm just looking at Tesla Auto. And how close is Tesla Auto based on this valuation model to the price that I see in the market right now, right? So basically, as you can see here, you can check my assumptions in a second, but that's the sales I see this year. So we have an EBITDA of $23.5 billion. That's with a 19% margin. And then on the right-hand side, there's little adjustments to higher growth of revenue for the next 5 years. So 30%, 40%, 50% per year for the next 5 years. And then at the bottom, we have the concurring EBITDA that's based on that new revenue. So here on the screen, you have the EBITDA, you have the effective tax rate of Tesla, which is 8%. By the way, if you want to get this data simply, like the tax rate, the EBITDA numbers, and all this stuff, you can go to Stock MVP. I'm going to put it on the screen right now, stock-mvp.com. Code LAST50 is the code to get it 50% off. So all the data I'm looking at here was taken from Stock MVP, which is my platform. So basically what we do here, we'll look at this as a 30% growth per year. It's the bear case for Tesla, $73 billion of capex for the next 5 years, a 14% discount rate, 8% effective tax rate. And what we get here is a valuation of $526 billion. That's the DCF valuation. You can make it kind of a little bit more realistic by putting it side by side with the EBITDA multiple valuation, which gives us $616 billion. And you can actually show us what's the blend. The blend here below is 166, 194. So the blend is $180. So bear case for Tesla, the floor for Tesla seems to be $180. Now the medium case, everything that we did here is very, very, fairly simple. All we did here is we increased the growth rate for the company from 30% to 40%. And again, we use the same 10 multiple for the EBITDA. Everything is the same. Everything is identical. So what we get here, based on the multiple system, is a value of $867 billion, sorry, and then a DCF value of $774 billion. Of course, you have to add up all these cash flows from the 5 years and this present value of terminal value of the long-term growth rate, and then whatever's left out of cash and cash equivalents, with the deduction of debt, obviously, net of debt. So in this medium case, the value of the company ranges between $774 billion and $867, which means one thing, the share price is ranging between $244 and $274. So the average is $260, currently trading at $250. Not a lot of meat on the bone as far as, a trading opportunity. However, if you look at the 50% growth rate for revenues, then you get something completely different. At a 50% growth rate for Tesla, which is doable, we're still at 14% discount rate, still at 8% effective tax rate. The number actually becomes $293 to $64, because now we're looking at anywhere from $836 billion to $930 billion in valuation. Again, 10 EBITDA multiple and 4% long-term growth rate. I urge you not to change that 4%. It's going to make your model absolutely berserk. So basically, on the bull case, Tesla is currently worth $293 in the high end and $264 in the low end. So it's not a massive upside, 11.5% upside. So as you can see here on the screen, Tesla is either overvalued or fairly valued. There's not a lot of opportunity here. But here's the catch. We haven't talked on sales about robotaxi. We haven't talked about AI. We haven't talked about the Tesla bot. We haven't talked about a lot of stuff. The $25,000 car, the improvements in margins Tesla will do, and all that good stuff. And I think it has to be part of this model at some point. But this is a very cautious model. So what I would argue here is that what we get here is the value of Tesla auto business without the robotaxi, without all the stuff that's developing right now. Just the auto business is fairly valued right now, because the medium case right here with the 40% gives us literally 260, which is very close to where we are right now. So if that is the case, what does it show us? It shows us that Tesla is not a cheap company. It's showing us that Tesla is rightfully so, of course, trading at a premium. And now the question is, right, what do you do when the share price is already at $250 and it's very, very close to your ceiling of 260? What do you do? Do you stop? Do you wait? Well, here's what you do. Again, at least according to my system that we actually talk about every single day in the Patreon. People fed up with me explaining it. So Patreon/Tom Nash. We have a new feature called Tom's Academy. It's absolutely insane. Sign up, check it out. It's a 1 month free refund in case you don't like it for any reason. So what I'm teaching in Tom's Academy is this. Even at $260, it's still a good time to buy Tesla. So there's two metrics here for evaluation. Either one is important. So number one, do you have the stomach to dollar cost average when the share price drops below a certain threshold and buy more, even if the company keeps diving, right? So if you have the stomach for it, the more important question here is, do you have a skill that allows you to pick a good company? Because you can dollar cost average in the perfect way into a really bad company. So how is your company picking process is? Because if you're going to be DCAing for 3 years into the wrong thing, well, it's not going to work out so well for you. So the question is very simple. How do you find these good companies? So if Tesla is a great company, we know that for a fact. We know because there's so much information about Tesla, right? So if Tesla is something that we can expect to see in 10 years dominate, and the current stock price is not cheap, do we wait on the sidelines for a dip and then buy all in? No. Now, if you do think that Tesla is the real deal, here's what you do. You start buying now. You ignore the price and you buy every single week, little by little, piecemeal by piecemeal, slowly building up your position. And as the price dips, you start to buy more. And as the price climbs back to 270, 280, you're back to buying your original amount. And you keep doing it again and again every single week until the stock price and your cost basis, they converge. You get the average, and because you bought more when it was down, you get way closer to the bottom of the stock in this entire time frame than anybody else. So it's not a bad time to buy Tesla, but I wanted to show you something really important, which is a DCF model should not be a way for you to justify your biases. So I have personal biases about Tesla. I think it's the best company except Palantir. I love it. I think it has massive trajectory, etc., etc., etc. But I didn't let it sink into my DCF. As you can see, the DCF says, well, this company is fairly valued. That means that the DCF is probably right. The company is probably fairly valued right now, and it doesn't have a lot of room to run up like crazy. But it doesn't mean it can't do it. That's the crazy part. So as long as you DCA and you don't play this gambling game, you should be, over the long haul, quite okay. I urge you to go to patreon.com/Tom Nash. Check out every single tier we got there. See the one that works for you. Of course, I would love to see you in the academy, but join whatever tier you want. It's risk-free because everybody gets a refund within the first 30 days if they're not happy for any reason. So as always, thank you so much. I hope this was helpful for you to see kind of the way a real Tesla DCF would look like without all the hype and hoopla around it. Thank you so much. I'll see you in the next video.